Hi everybody, myself Dr. Abbas Vattoli, Assistant Professor, Amal College of Advanced Studies, Nilambur. This video is about Glossary of Capital Market. In this presentation, I will be explaining 40 important terms or definitions relating to capital market. In order to get an idea about the content of this tutorial, I have listed few terms which will be discussed in this presentation. ASBA, beta, demutualization, green shoe option, programmed trading, reverse book building, and samurai bonds. Let's begin. American Depository Receipts. It's a certificate issued in the United States in lieu of a foreign currency. The ADRs are traded in the US exchanges as if they were a domestic stock. American option. A put or call option that can be exercised at any time prior to expiration. In case of European options, it can be exercised only on maturity. Application supported by blocked amount. ASBA means an application for subscribing to an issue containing an authorization to block the application money in a bank account. Bank assurance. The phenomenon whereby a financial institution combines the selling of banking products and insurance products through the same distribution channel. Basis. In futures market, basis is defined as the cash price of whatever is being traded minus its futures price. Behavioral economics. Combination of psychology and economics that investigates what happens in markets as a result of human limitations and complication, popularly known as irrational behavior. Beta. A measure of the volatility of a stock relative to a market index. A low beta indicates relatively low risk. A high beta indicates a high risk. Capital asset pricing model. An economic theory that describes the relationship between risk and expected return and serves as a model for the pricing of risky securities. Certificate of deposit. A negotiable certificate issued by a bank, usually for a period of 1 month to a year, as evidence of an interest-bearing time deposit. Counterparty risk. The risk that between the time a transaction has been arranged and the time of actual settlement, the counterparty to the transaction will fail to make the appropriate payments. Credit rating. Credit ratings measure a borrower's creditworthiness and provide an international framework for comparing the credit quality of issuers or borrowers. Current yield. A measure of the return to a bondholder calculated as a ratio of the coupon to the market price. Demutualization. The process of transition from mutually owned association to a company owned by shareholders. Direct quotation. The quotation of variable units of domestic currency in terms of a fixed units of foreign currency. Example, 76 rupees for $1. Diversification. Spreading the risk by constructing a portfolio that contains many different investments whose returns are relatively uncorrelated. Diversification leads to risk reduction. Exchange traded funds. A security that tracks an index but has the flexibility of trading like a stock. Gilt-edged, a term used to describe a bond generally issued by government or issued with a government guarantee. Green shoe option. Green shoe option means an option of allocating shares in excess of the shares included in the public issue as a post-listing price stabilizing mechanism. Insider trading. The practice of corporate agents buying or selling the corporation's securities without disclosing to the public significant information which is known to them but which has not yet affected the price. ISIN, International Securities Identification Number. It's a unique identification number allotted for each security in the depository system by Securities and Exchange. LIBOR, London Interbank Offered Rate. It's often used as a basis for pricing euro loans. LIBOR represents the interest rate at which interbank loans are offered in London money market. Liquidity Adjustment Facility. Under this scheme, repo auctions for absorption of liquidity and reverse repo auctions for injection of liquidity will be conducted on a daily basis. Market capitalization. The market value of a company calculated by multiplying the number of shares issued and outstanding by their current market price. Merchant bank. Any person who is engaged in the business of issue management, either by making arrangement regarding selling, buying or subscribing to securities, or acting as manager, consultant, advisor or rendering corporate advisory service in relation to such issue management. Net asset value. The current market worth of a mutual fund's share. A fund's net asset value is calculated by taking the fund's net asset dividing by the number of units outstanding. Odd lot. Anything less than the standard unit of trading, that is round lot. Program trading. A technique which uses decision rules usually programmed on a computer to generate trading decisions automatically. Random walk theory. It claims that a stock's past price action is not geared to future prices because prices move randomly and not in a pattern. Red herring prospectus is a draft prospectus which is used in book built issues. It contains all disclosures except the price. Reverse book building. Reverse book building is similar to the process of book building, which is aimed at securing the optimum price for a company's share. In reverse book building, the investor's aim is to sell the shares to exit the company. Samurai bonds. Foreign bonds offered in the Japanese bond market. Securitization. The process of packaging financial instruments into a new fungible security. It converts non-marketable assets into marketable securities. Sweat equity. A sweat equity share is an equity share issued by the company to employees or directors at a discount or for consideration other than cash for providing know-how or making available rights in the nature of intellectual property rights or value additions. Systematic risk. Risk that affects an entire financial market or system and not just specific participant. It is not possible to avoid systematic risk through diversification. Tracking error. When using an indexing or any other benchmarking strategy, the amount by which the performance of the portfolio differed from that of the benchmark is called tracking error. Underwriting: an agreement with or without conditions to subscribe to the securities of a body corporate when the existing shareholders of such body corporate or the public do not subscribe to the securities offered to them. Warrant: an options contract often sold with another security. For instance, corporate bonds may be sold with warrants to buy common stock of that corporation. Warrants are generally detachable. Window dressing: a malpractice often engaged in by companies, banks, mutual funds, etc. at the end of the accounting period in order to impress stockholders by showing that funds are better managed and invested than what might have been drawn up. Yankee bond: a bond offering in the United States domestic market by a non-US entity registered with Securities Exchange Commission. Zero coupon bond: a bond that pays no interest while the investor holds it. It is sold originally at a substantial discount from its eventual maturity value, paying the investor its full face value when it comes due. Thank you for watching. Contact me at abbasvattoli@yahoo.com.